have a best car, okay, you might have a Ferrari, you might have a Lamborghini, but then if there is no fuel, what's going to happen to the car? You might end up with like the man who's standing over there, right? Okay, you can have the best car, but then you cannot move anywhere. It's actually the same case to a business. A business can have the best of ideas, can have the best of teams, can have the best of products, all right? But then without the fun, in the fuel in a business world, we call as a fun. Without the fun, we cannot travel so far. You might, and sometimes with a great idea also we have to be stuck. So our speaker today is going to talk about this. This is the talking about the fuel for business. This is the topic that he want to bring up. And for that, I need to welcome the speaker. The speaker is Mr. Chris Wong, the founder of Metro Capital. Of course, he has vast experience in funding and also consulting a lot of companies to go through stages for them to go get funding in their business journey.
Thank you so much to MCM for inviting me for today's talk. I try to be as informative as possible, and to be honest, to be really honest, this topic is not very strange to me. I've been doing this thing for the last 10 years, but I got to be very honest. I only did this slide yesterday when Heman actually reminded me. But anyhow, most of the stuff are there. All right. I see some familiar names. I see some new names there. I hope that I can be, as I said, informative as possible. So tonight we're going to talk about understand startup financing stages. Now, before I start, of course, in the market we have heard a lot of what we call it Series A, Series B, Series C, and Series D. But what does this series really mean? And at what stage does the company actually go into which series to raise funds actually? But most of the time in the market, you will hear of entrepreneurs always telling people that they are raising Series A. Very seldom you hear entrepreneurs telling you that they are raising Series B actually. Now, I'm going to give you all these differences later on as we go on, right? So I mean, you can read from what I shared in the slides over here. All right. Now, Surin started the whole conversation very well tonight. All right. You can drive a very fantastic car, big cars, a small car, but the important thing of the car is the fuel. Now, whether you use RON 97 or you use RON 95, it really doesn't matter because it's the fuel that's important for vehicle to move. So very similarly to business. Business is just not about ideas, but business is about financing, right? Now, many of people actually been circulating WhatsApp saying that Malaysia actually, especially Khazanah, actually missed the opportunity to invest in Grab. And we have a very good Malaysian company, but right now they are in Singapore, and then the listed Khazanah actually missed the opportunity, or I would say waste the opportunity to actually make billions from Grab IPO. Now, there are true and false on that, but we're going to speak about that shortly, right? But remember the things that I mentioned about Grab and Khazanah. I'll come back to you shortly. So it's more than business idea. It's about money. Many of times investors raise not enough money, but they got good ideas, and what happens is that the business cannot sustain anymore. It goes bust. But the good news is there are more dry powder in the market right now. Now, in the financial circle, dry powder means cash flow. Business, we call it cash flow. But for investment, we call it dry powder. Right? So it's two different terms. When you say cash flow, it's business. When you say investment, it's actually dry powder. Right? There are more dry powders in the market because a lot of business is having good high valuation, and a lot of startups is actually doing very well. Right? So we're going to talk about pre-seed funding tonight, seed funding, Series A funding, Series B funding, Series C funding, and Series D funding, and then we're going to talk about IPO. Now, normally, from what you can read over here, startup funding has transformed the business landscape completely over the last few years, especially post-pandemic. Many of the countries have moved into endemic. We are still in pandemic stage, but that's why we say post-COVID, right? Now, 4 or 5 years ago, ECF is not very popular in Malaysia, equity crowdfunding. So there's not much fundraising option, legal fundraising option, all right? But now today in Malaysia market, we have 12 ECF platform, and I'm actually a partner of Atta Plus, the second biggest or largest ECF platform in Malaysia. So for startups, they have a lot of opportunities to actually use ECF to do proper and legal fundraising. We're going to talk about that also as well very shortly. Now, this is actually the graph that I mentioned just now, seed stage to angel investors, early stage. Now, seed stage has 2 stages. One is pre-seed stage and one is seed stage, right? So we're going to talk about that very shortly. But angel investor is also in seed stage. Early stage is also in seed stage, early stage investment, right? Then you're going to round A, round B, round C, and then mezzanine. Now, startup funding stages. A step-by-step illustration on startup funding. All right, so we got a pre-stage. Now, what is pre-stage? This stage is commonly known as bootstrapping. Keyword bootstrapping, underline that. You must use your own existing resources, which is money, your time, your own office space, your own laptops, your own electricity, your own coffee, whatever you call it, your own resources, including money, in order to get the operation off the ground. So many of times, investors actually started from their own garage. Look back at the success story of Michael Dell and also Apple, the late Steve Jobs. They started inventing or assembling computers and software in their own garage. All right, so that is called bootstrapping. All right, and the valuation is normally not high, between $10,000 to $100,000. So in Malaysia, anything below $500,000 is considered pre-stage, very, very pre-stage. Now, obviously, you will tell me, Chris, this business got no revenue, this business got no traction yet, whatever. There's no revenue, there's no traction. Basically, this is a two fundamental basic thing. But that business definitely has a value of 300,000 or $500,000 because of an idea. An idea has a value. That is why it's called intellectual property. So potential investors are normally startups, owners, family, friends, and family. All right, we call it 3F, family, friends, and fans. All right. So it is actually exploring the feasibility of building an idea into product and services, testing the market, and developing the market and sales plan for product launching. So usually this kind of a stage, the fundraising is about $50,000, which is about 200,000 ringgit. And that is why, Surin, many of times when you heard about angel investors, they said they invest 50,000 ringgit or 100,000 ringgit. That is the normal size of pre-seed stage fundraising. Pre-seed normally 50,000. So you got about 2 or 3, what we call that, angel investors. Then you got about 150,000. So probably normally you need that much because your manpower is not a lot. The manpower could be about 2 or 3, the founders, co-founder, and another operation manager or sales guy. So you got about 3 people there. And usually founders at pre-stage, they don't take salary. Probably just take their claims for their mileage, petrol, fuel, and whatsoever. Right? Then we go into the seed funding. The seed funding, if you look back at the graph over here, is actually the early stage, right? So you look at the seed funding. During this stage, a startup receives help in determining the final products and demographic. They have not launched their product yet. But somebody kind enough that Surya will give them that 200,000 ringgit, and then they will start with their ideas. Right? Startup valuation is between $3 million to $6 million. That is between $800,000 to $1.5 million. But again, it's chicken and egg story. Sometimes you as an investor will say that, hey, you don't have any traction yet, but you can command $3 million to $6 million valuation. Now, in US, they really price, I would say US, in the Western world, they really price intellectual property. But over here in Southeast Asia, To us, intellectual property is just an idea. You know why? Because we've got too many people sitting in the coffee shop and talks about idea. So a lot throwing of ideas and go and so forth. But startup valuation in US is normally between 3 million to 6 million US dollar. But in Malaysia, unfortunately, most of the time, or in Southeast Asia, our valuation, if you can get 1 million or 2 million ringgit, that's good enough. That's very, very good. So different places have different set of rules on how they look at startup valuation. Then obviously the potential investors are angel investors or your family and friends, and micro VCs like MCM and crowdfunding. That's where ECF crowdfunding come into place. So the startup stage for seed funding is mainly launching product. They already have the product. It is in the final stage of testing, and then they launch the product. And then they build the traction until the revenue starts to come in. That is why you see the graph. This is the Y graph, this is X graph. You see that the traction for revenue and the traction for customer acquisition will continue to go high. So like for example, first month you do 10,000 ringgit sales, second month you do 30,000 ringgit sales. Well, that is how many percentage of growth? There's 300% of growth, correct or not? And then third month you do 600,000 ringgit sales compared to 10,000 ringgit for the first month. We are talking about 6,000% revenue growth. So during this stage, the numbers look bombastic in terms of percentage. Okay, so but they continue to develop what we call that product for what we call that development of product for market. The product is not perfect, but they continue to develop the product. All right, to make it more appealing to the market. Approximately fundraising in the US is very small. We're talking about $3 million US, which is actually about 12 million ringgit. But obviously in Malaysia, 12 million ringgit is a big deal. If you have the time, drop down this note and Google this Naluri. Just Google Naluri Malaysia. Naluri has recently, I think about 3 or 4 months back, they did a fundraising of $5 million US, that's 20 million ringgit. In the US or the Western world, $5 million US is chicken feet and nothing. But it's a big deal because in Malaysia, somebody can raise 20 million ringgit for a second round or for Series A. That's considered a big amount. So Naluri is actually in the health tech sector. They raised 20 million ringgit or about $5 million US, but it took them 9 months to do that fundraising. So in the States or in Europe, $3 million US is taken up in like less than 2 months. But Naluri, as I said, because it's Malaysian, we don't have that ecosystem. We are right now building that ecosystem. So it takes some time and it took them 9 months to build. Now, obviously, we got Series A. In the first round of venture capital financing, it is the first round of VC financing, not pre-seed. So in this stage, the startup is all set in terms of product development and has to provide preferred stocks to investors. Now, the keyword is preferred stocks to investors. Can you see that? Preferred stocks. Now, some VCs that come in, they take both equity and preferred stocks. So you have a hybrid mixture. So you take equity, which is shares, or you take preferred stocks. Preferred stocks is actually redeemable preference shares. It's actually a debt note, right? So over in Core Metro and MCL, we do a lot of debt note, which is actually RPS, redeemable preference shares. Now, of course, in Core Metro Koperasi, as well, many are familiar with, we issue deposit and loan agreement in Koperasi, but to tie up with the company that we give the loan to, they actually issue us preference shares because it has to be, because director's guarantee can only go so much. So with the preference shares, it's actually locked in with director's guarantee. That's how we do it, right? So potential investors are accelerators. Obviously, some of the very famous accelerator is like Startup 500. And then obviously MTDC, Malaysia Technology Development Corporation, also has its own accelerator. Myself and Max Shankar, we are actually Magic Global mentor. Magic Global also has its own accelerator. And then we have the super angel investors, which I say the very high network. We are talking about private banking over here and venture capitalists. So at this stage, it's actually the business model already worked. And the key team is in place. You can't raise a Series A if you don't have a proper team. In seed round or pre-seed round, you can still raise money, but you don't have a COO. You are the CEO, you are the COO, you are the sales manager, and so forth. But in Series A, you practically have a functional team. And you got further development of products and services, scalable market blueprint, and approximately fundraising is about 60 million ringgit or 15 million US dollar. But in Malaysia and Southeast Asia, normally Series A, Series A is between 3 million to 5 million US dollar. That is Malaysia. That is why in ECF last year, Security Commission has approved companies that listed in ECF to actually do fundraising more than 10 million ringgit, not more than 10 million, up to 10 million ringgit. So to SC, anything that is about 10 million ringgit, which is about 3.3 million US dollar, is actually Series A. You see, in the States or the Western world or in Europe, they are talking about 15 million US dollar. But over in Malaysia, we are talking about 3.3 million US dollar for Series A. You see the gap is about 4.6 times lesser. Now in Series B, obviously, this stage allows startups to grow so that they can meet the various demands of their customers. So you already have a workable product, all right? Like for example, when Daihatsu partner with Toyota, is it? Daihatsu partner with I think Toyota and set up Perdua, right? And set up Perdua, right? So what stage are they in if they were to raise money? All right, obviously it's a new startup, but because Daihatsu and Toyota is a brand name, they can immediately raise a big chunk of money for that new venture, which is called Perdua. So it is actually to meet the various demands of their customers. I'm just giving an example, right? Startup valuation 30 million to 60 million, which is about 120 million to 240 million ringgit. All right. So obviously the potential investors are venture capitalists and late stage VC. In this stage or at this stage, they scale up the market, they increase market share, they build high quality teams and outlive competitors. So many of times in Series B, right now it's very common, but a few years ago it's not. Many companies that is Series B begin to raise funds to take over smaller competitor. All right. Now, in theory wise, it's not Series B. Theoretical wise, it's Series C. But we're going to touch about that shortly as well. But a lot of companies that raise Series B start to take over competitor. It means that startup, not mature competitor, but startup that is struggling, but they have ideas and they know that these ideas can actually integrate and complement the business, right? So that is how Series B will outlive the competitors. And approximate fundraising is about 30 million US dollar, which is about 120 million ringgit. But again, as I said, in Malaysia, it's a bit different story. In Malaysia, Series B, we are talking about just now 3.3 million US dollar. In Malaysia, it's about 5 million to 6 million US dollar, which is about 20 million ringgit to about 24 million ringgit. Okay, so then obviously we got Series C's and beyond. In this stage, startups search for more funding to help them build new products, reach new markets like overseas expansion, even acquires other underperforming startups, like what I mentioned earlier. That's why I touched a little bit on this here. And obviously the valuation became 100 million to 120 million. But from here, they will grow up to 1 billion US dollar, become a unicorn. All right. Now, if you talk about beyond, which is Series D, I used to be based in Hong Kong back in 2018 and 2019. All right, before the pandemic. So when the pandemic starts in March 2020 last year, obviously all of us cannot travel, so I'm based in Malaysia. But when I was based in Hong Kong, I always visit late stage VC. Is very surprisingly my experience. When I walk into the VC office, they always have a cabinet and they put trophies, But obviously the trophies are not like us in Malaysia. Those kind of big trophies are those kind of crystal trophies. Hong Kong people, they always have this crystal trophy inside their cabinets. So whenever I go into a late stage VC office, I always find it surprising to see an EPF, KWSP, what we call it, crystal trophy or appreciation plaque. Okay, over here in Bursa Malaysia Security Exchange or EPF, they don't give certificate. Yeah, as you can see at my back, I got a big certificate there. over in that part of the world in Hong Kong, they always give or take crystal trophy. So KWSP give crystal trophy to them. So they put inside the cabinet, and I actually take a read. I read what is engraved in the crystal trophy, and it is written as appreciation to our partners. Partners, the word is partners. It's not an award. So I start to ask, I start to ask the people that I met like Noel and so forth. These are the people that I know in Hong Kong. So I asked them, you are partnered with EPF. Can you tell me what you do with them? Oh, they are our late stage investors. So immediately I know already. So EPF actually, our Malaysian EPF actually invests in a lot of late stage deal in Hong Kong. Now, what is late stage deal? Late stage deal means that company already knows that they're going for IPO, and it's a matter of time that they're going for IPO. So EPF normally invests in this kind of deals that is going for IPO in less than 2 years, between 12 months to 18 months lah. So when EPF go inside there, it's a sure win. It's a sure win. It's just like 2 weeks before Grab is going for listing. 2 weeks before Grab is going for listing, and they suddenly offer you shares. You know that if you're going, you should make money. But obviously, Grab, when they listed, it went down 20 million. Not 20 million, 20% of the shares. So there's another story. So I was just now talking about Khazanah and also Grab, right? Now why did Khazanah didn't invest in Grab? It is because this is something that you as an investor need to know. It is because every fund house, whether they are sovereign funds or they are private venture capitalists, they have a specific mandate to invest in. Okay, so certain company can only invest in trading. Like for example, I give you Novus Capital. Novus Capital, they only invest in companies that involve in trading, jual beli, buy and sell products, right? So they invested into one Malaysian company into buying durian and selling durians to China. Okay, so they also invested into other agriculture companies that buy and sell. So that is Novus Capital. So that is their mandate. Their mandate is in agriculture. Now some VCs, their mandate is to invest into health tech. So it depends on that particular mandate. So Khazanah at that time doesn't have the mandate to invest into startup. So that is why Khazanah couldn't go into that deal actually because of the mandate. So you got to understand why Khazanah did not did the investment. So EPF only have the mandate to invest into late stage. It means that Series D can go IPO already. All right. So at this point, it's actually expansion, increase market share, and put the company on IPO track. And obviously, the last part is IPO, right? And their valuation is actually 400 million and above. But in Malaysia, it's a different story. If you got 100 million ringgit, you can go IPO already, valuation. So to go into second board, which is Ace Market, you need a minimum of 100 million valuation. Then you can go into second board. All right. So when you go into second board, it depends on how much you can raise. Probably you raise about in Bursa 50 million ringgit or 30 million ringgit. But obviously in the Western world or Europe, it's different, 50 to 500 million, right? So the startup stage is actually growth oriented. The IPO stage is more growth oriented team, proper and stable financial statements. They already developed a good corporate governance and have positive market sentiments on their product and services. Now, these are some of the things, how to determine the amount to raise in each round, all right? In order to determine the funding required for your startup, all right, for your startup, just hold on, I try to minimize my, not better. Now, how to determine the amount raised in each round? In order to determine the funding required for a startup, you must apply the simple formula. Let's say, for example, you are a new startup. Okay, you want to raise the first round, seed round. Very simple. All right, what is the cost of your? What is the monthly cost? Let's say your break-even cost is 15,000 ringgit. Your payroll, your allowances, and then your claims, your office costs, operation costs, whatever cost lah, it comes out to 15,000. So 15,000 you times with 18 months, and then and you times with the cost of one person is actually 15,000. So you multiply by 5 and then you multiply by 18 months, you got 1.35 million. But let's say, for example, your cost is actually 15,000 per month. So you can take 15,000 multiplied by 18, your cost is 270,000 ringgit. So that's how you raise your funding. So many of times founders are not able to explain to the angel investors why they need this much of money. So to me, it's very simple. My operating cost a month is 50,000 ringgit. I need 18 months to survive. So my total raise is actually 270,000. Now, obviously, the investor will ask you later on, does your what you call it? Does your funding includes product development and so forth? So in the case whereby you are a service company, obviously as a service company, you don't need cost for product development because it's more manpower cost. So my 15,000 a month or 207,000 for 18 months does not include product development because it's service based. But in the case of what we call it, but in the case of let's say for example you have physical product development, and then you need to include your what we call it, your physical product development cost as well. So this is a rough estimation of the minimum funding. This is a synopsis of what I mentioned earlier just now, the pre-seed round to the seeding round, Series A, B, C, and D funding. Talking about D funding, I have a very interesting story to share. I know a VC based in Sydney. His name is Dr. Chu. Yeah, Dr. Chu, right? So the last I met him was 2 years ago before the pandemic. So what happened was that he was sharing with me that there was a company in the States actually that he actually funded. So and the executives are all Americans. So being Americans, you know that they actually spend more than they earn one. That is why America is the country that has the most credit card debt in the world. They always spend more than they earn. Okay, so what happened was that he raised quite a lot of money for them until Series C, D, E, F, G. Until G, you know. Imagine that. I mentioned just now C and D already can go IPO, but they raised until Series G. So the Americans always spend beyond their means, lavish executive bonuses, salary, cars, and so forth, and lavish office. But then the R&D flop, the market expansion flop. So he has no choice but to do another round called A, B, C, D, E, F, G, H, G, H, am I right? Surin, after G is H, yeah, H. So he has no choice. Okay, so he did a Series H fundraising. He pumped in the money. All right, the CEO also couldn't make it. Then finally, he decided to fire the CEO, and then the company was left with a shelf only. Nothing is inside there. But the company still got good prospect because the intellectual property, the idea, the products are still, to his opinion, is still marketable. So what happened was that he went and raised a Series I. Can you imagine that? They raised Series I. So when they raised Series I, they pump in the money inside there, they revive the company, and then they list them. Finally, they list them so that the previous investor can all cash out. Okay. Now the next question is The next question is I can't read my screen because the top bar there it was how much equity to pay to an investor in the seed stage. Now in the seed stage, assuming that you have good traction with impressive growth of your startup at the seeding round, if you are raising 1 million ringgit of seed funding, then usually venture capitalists would want to get 10 to 20% of the startup's equity. Angel investors a little bit higher, 15 to 25%. There's an error there. It's 15 to 25% of the startup equity actually. So angel investors are the same as retail investors. Normally, their cost of financing is higher. That is why you see that they get 15 to 25%, whereas a venture capitalist get 10 to 20% of startup equity. All right. Then the next question: how to get seed funding? If you have recently launched your startup and you bootstrap, as I said earlier on, it means you use your own resources, including money. So the best person is actually to for you to approach is actually 3F, your friends, family, and friends. All right, family and friends. But obviously, we always make the joke is fools that will believe in you. But that's a joke. Angel investors or venture capital firms refrain from investing during the idea stage, as they are unaware of the level of dedication and how well your idea can evolve into a profitable business. That is why seed funding is always bootstrapping and your 3F network. Okay. Well, I actually touched this already. But I can just overall go through and say that Series A funding usually starts when startup is profitable, or not profitable, but at least they have reached the break-even stage. Or if they are not profitable, they are not reached the break-even stage, their traction is very good. Their growth every month is 100%. It's all in 3-digit. Okay, so A represents the official funding of that company or enterprises. And when enterprises invest, it is in millions of dollars. So when enterprises invest, it is actually known as what we call an institutional investment. Okay, so then you go through the seed fundings as what I mentioned earlier on. But as an announced IPO, they can do more funding. But technically speaking, as I mentioned just now, there is no last stage of startup funding. And if a startup or a company has more advanced goal, then they may go into Series E, F, G, and so forth. Now, what happens if the company already listed? Okay, what happens if the company already listed? All right, if the company already listed, then they don't do series funding anymore. So once you are listed, you no longer do series funding. You do what we call growth funding. Remember the first graph that I showed you, mezzanine capital? Now you do mezzanine capital funding. So mezzanine capital is a long-term debt, let's say 5 years to 8 years or 10 years. And then when they reach certain milestone, you can actually convert that mezzanine debt into equity as well. So, or you can actually raise new funding through shares issuance. Like last year, I always give this example in my talk. AirAsia couldn't fly at all. But do you know that last year AirAsia still managed to raise 600 million from SK Group. So they give away 10% of their shares. So the company is worth 6.5 billion, if I'm not mistaken, because 10% of 6.5 billion is 650 million. So last year AirAsia actually raised 600 million ringgit, okay, in exchange of 10% of the equity to SK Group. So it's no longer series A, B, C, D, E, F, G. It's actually equity funding because they are already listed, okay? Or they may do debt funding, which is actually preference shares. Now, I hope that explains well. Thank you so much, Surin, for the opportunity.
Yeah, thank you so much, Chris, for sharing.